Welcome to our 2021 strategy update and our first time virtually hosting this annual event. We're delighted that you've taken time out of your schedule to join us as we delve into next era wealth planning for this new way of life we all find ourselves in. For our 2020 market outlook, we titled the event Shifting Tides, not quite realizing that the tides would be shifting more than any of us could have expected. It's safe to say that 2020 was a year unlike any most of us have experienced in our lifetimes. But despite the ebbs and flows, we are proud to report that for Bartlett and for the clients we serve, it was a very strong year. Our team and our clients transitioned from a traditional office to tech-savvy telecommuters without really missing a beat. We found new ways to connect and to do business. We engaged with each other and shared valuable information through interactive virtual meetings and webinars. Bartlett was named to the Barron's Top 100 RIA Firms list for the second year in a row. Our onboarding of new clients in 2020 was record-breaking, and the firm's retention levels have never been higher. And we experienced over 7.5% growth in assets under management. Through it all, we remained focused on our top priority, that is providing personal, proactive client service that's of the highest caliber. This year, our event is titled New Ways of Life. In the spirit of new developments to come in 2021, I'm pleased to announce an evolution in Bartlett's leadership. As of January 1st, I transitioned to the position of Executive Chair, while Jim Hagerty assumed the position of CEO, and Mazzocca, President. As Bartlett has grown, the necessity of separating these two crucial roles has become more apparent, and this time of transition seemed appropriate in creating two separate positions, each with distinct functions. Jim and Holly are supported by a management committee comprised of next generation and senior leadership. This team reflects Bartlett's ongoing commitment to positioning the company for future successes, just as we have for the past 122 years. This management transition has been in process for over 18 months, and we expect this next phase to be smooth and orderly. Today, Jim and Holly will be engaging in a discussion around new ways of life that 2021 will bring and what that means for wealth management. This conversation will be facilitated by Aliya Riddle, Bartlett's Associate Investment Advisor. So, without further ado, please join me in welcoming Aliya Riddle, Jim Hagerty, and Holly Mazzocca for the 2021 Strategy Update.
Hello, and welcome to Bartlett's 2021 Strategy Update. My name is Aliya Riddle, and I'm an Associate Investment Advisor here at Bartlett Wealth Management. On the webinar screen, you will see the Q&A button in the Access panel. Feel free to submit your questions throughout the presentation. We encourage you to include your first and last name in the question so we can follow up with you if we're unable to answer your question today. You can also toggle the size of the speaker versus the size of the presentation slides if you'd like. Let's introduce our panelists. As the moderator of this discussion, I'll let you know that it was no small task trying to rein these two in, as they would gladly speak for hours on these topics, so you're welcome. First, we have Jim Hagerty, Wealth Advisor, Principal, and now CEO of Bartlett Wealth Management. Jim has been with Bartlett for 26 years, so he's been around the block quite a few times. But at this point, we know that knowledge will serve him well as CEO. Next, we have Holly Mazzocca, a wealth advisor, principal, and now president of Bartlett Wealth Management. Holly has been with Bartlett for 5 years, and if you haven't met her, she is the human form of the Energizer Bunny, and I know that she will bring that energy to the role of president. So if we rewind to last year's market outlook, we suggested that there were a number of risks in the economy and the markets that we were seeing for 2020. Well, we'll be the first to admit that we didn't see the coronavirus coming. But as we reflect on 2020, it wound up being a very rewarding year for patient investors. Who would have imagined these good results back in March? I know I didn't. We think the events of 2020 reinforce some timeless investing principles, and Jim will take us through a few of them.
Well, Leah, you're exactly right. We think 2020 reinforced some timeless investment principles, and foremost among these is that you should not time the market. Don't try to time the stock market. We have a favorite saying at Bartlett that time in the market matters more than market timing. Put another way, the long-term investor does better than the person who tries to trade in and out of stocks. Now, it might have been tempting to time the market last winter. We were in free fall. The stock market from the high on February 19 to the low on March 23rd fell 34%, one of the severest and quickest bear markets in memory. And of course, the economy briefly imploded. Unemployment less than 4% in January, and in no time, it was almost 15% in April. And yet, just as things seemed so incredibly grim, help arrived in the form of very aggressive monetary and fiscal policies. The Federal Reserve reduced interest rates, and Congress and the White House cooperated and enacted a variety of stimulus packages, so that by late spring, early summer, the economy was clearly on the mend. Indicators were turning up, and the stock market was on its way to a fantastic comeback. Now, there have been a lot of naysayers. Many have questioned that the market would come back so strongly, while the economy at times has seemed fragile and the recovery tenuous. But in fact, history shows us that this is the rule and not the exception. And on this chart, we show our viewers the last 7 major economic setbacks in the United States. The first 6 of these were recessions, and the last one we itemized from last winter was like a brief depression. The economy really imploded. So in the second column, we show you the exact date at which the stock market bottomed in each of those periods, bottomed and began coming back. And then in the next column, we show you the month in which unemployment peaked, which you might take as an indication of when the economy bottomed out. What we call your attention to is the gap between those 2 columns. What you'll see is in each situation, the stock market bottomed out and began recovering before the economy. And sometimes the lag time might have been 3 to 6 months. And then the last column, highlighted in green, shows what was the rate of the stock market return or comeback during that period of time. And they were all positive, and 6 of the 7 remarkably positive. The one outlier was complicated by the September 2001 terrorist attacks. But remarkable progress in those early stages as the stock market bottomed out before the economy. And this inevitably is what confounds the market timer, the fact that stocks begin coming back and the market recovers not because things are good, but merely because things are starting to get better. So related to not timing the market is the importance of always maintaining good portfolio safeguards. And here we highlight 2 of our favorites: asset allocation, which is the blend in a portfolio among stocks, bonds, cash, and alternatives. And portfolio diversification which relates to the way in which investments are spread among different parts of the economy. Now, we think with these key safeguards in place, asset allocation and diversification, a portfolio should be relatively resilient when we have difficult markets. And that should give an investor the fortitude to maintain her investments rather than feeling the need to react and sell when prices are low. And furthermore, these safeguards should also position an investor to rebalance and opportunistically add more to stocks at lower prices. So these very, very important safeguards. So to Bartlett, those are the key takeaways of 2020, the timeless investment principles that were reinforced, not trying to time the market and being attentive to good portfolio safeguards. These are the things that helped us navigate 2020, and they'll help us overcome whatever turbulence comes our way in 2021.
All of these are great reminders, Jim. And with that, we actually have our first question from the audience. Jim, you talked about the stock market moving before the economy. And one listener wants to know when and how the two could become more aligned. Is there a point when stock prices better reflect economic reality?
Well, Aliya, what history shows us is that after those initial stages of really fantastic progress, as the market comes back, even though the economy may still seem tenuous, what tends to follow is the economy settles in at a better growth rate, but then the market slows down a bit. And it slows down because pressures build, such as higher inflation or higher interest rates. And we could see that play out in 2021 with a stronger economy, but stock market returns that are maybe just a third to a half as good as what we experienced last year. That's how those two might come into better alignment.
Great. Well, we could easily spend all of our time today on the roller coaster of 2020, but let's move on to what's holding our attention for 2021 and beyond. Jim and Holly will lead us through 4 very interesting trends that we think could have an impact on some of our investment decisions going forward. While these trends had been brewing under the radar, the lockdown environment of COVID swiftly accelerated their rise to the surface. The 4 trends that we'll be discussing today are innovation in healthcare, the growing use of renewable energy, the continuing shift to cloud computing, and disruption in higher education. Jim, let's start with some of the exciting developments we're seeing in healthcare.
Well, Aliya, there's no question that healthcare was really at the forefront of our ability to surmount this crisis. And Bartlett believes very strongly that the mega trend of ongoing medical innovation and continuing scientific breakthroughs is going to be an enduring one that's going to really pay dividends for our economy, and it's going to be very important for portfolios. When we met a year ago, January of 2020, it was the first time we were hearing about this thing called the coronavirus, and here it is. A year ago, we were reading about this in connection with China and these amazing lockdown measures they were undertaking in big cities like Wuhan. And yet it was only 4 to 6 weeks later that it was manifesting with a vengeance throughout Europe and the United States, and we were engaging in our own containment measures. And here we are, probably on our way to a total of 500,000 deaths. A healthcare catastrophe, the likes of which we haven't seen since World War I. And our thoughts go out to all the families who are bereaved from the loss of loved ones. But the coronavirus and those things on the outside of the virus, those red stalks, are called spike proteins. And I point that out because I'll be returning to spike proteins momentarily. So a year ago, really a time of emergency and all hands on deck in the American healthcare system as we sought to find either a medicine for the coronavirus or, better yet, a vaccine. And more than 100 different research and development programs were launched targeting the development of a vaccine. Now, it seemed like a very, very daunting challenge trying to develop a vaccine because historically, less than 5% of attempted vaccines have ever achieved FDA approval. And of the vaccines that are approved, the development time is average 10 years. And the record time for development had been 4 years. So a very daunting challenge. And yet here we are in less than a year's time. 2 coronavirus vaccines have been FDA approved with amazing effectiveness, 90 to 95%. Just an amazing achievement. Might say, as a golfer, I might say it's a scientific hole-in-one. And the question is, how did it happen? Well, we owe these initial successes, these first 2 vaccines, to a gene sequencing research and development approach called messenger RNA, or mRNA for short. And there isn't time today to go into all the intricacies about mRNA, even though it's fascinating. What'll suffice for today is just to tell you how these vaccines will work. When you're injected with these vaccines, your body will be stimulated to produce those spike proteins that you saw on the outside of the coronavirus. And then your immune system will be prompted to attack anything with those spike proteins. That's how these will work. Now, these vaccines are promising because they can be produced at a fairly large scale. They seem to generate a stronger immunity. And another important characteristic is that they seem to be adjustable. That is to say, they can be tweaked if the virus mutates. And that's certainly an important consideration given recent events. Additionally, these first 2 successes with mRNA vaccines bode well for other vaccines that are now in development based on traditional methods. And that is because these other vaccines that are coming along will work in a similar fashion. They will work by attacking that spike protein you saw on the outside of the coronavirus. So these early successes are perhaps a leading indicator of more successes to come, more vaccines that will be approved. The additional good news is that there is the potential that this mRNA approach could be what's called a platform technology, which is to say the gene sequencing approach that was at the heart of developing these early vaccines could also be effective in other areas. And the approach so far has showed some promise, for instance, with melanoma and with cystic fibrosis. So some very interesting potential. Well, the key takeaway to all this is that these fantastic successes just highlight the enduring megatrend of our leadership in healthcare and ongoing scientific innovation by virtue of very strong research and development. Healthcare will be a very important part of portfolios, a very significant contributor to the economy. And in most portfolios, healthcare stocks account for the 2nd largest sector behind only technology. And so it's very, very impactful for investors. And in closing this segment on healthcare, we just highlight various companies that we admire and own in portfolios. We have healthcare companies all across the healthcare economy, from biotechnology, pharmaceuticals, hospital supplies, diagnostic equipment, research and development supplies and processes. All of these companies and others that will undoubtedly add over time are really at the epicenter of ongoing healthcare innovation that we think is just going to have enduring significance for our economy, and it'll be very important for portfolios given the contribution of healthcare stocks.
Well, it sounds like the mRNA research could be a real game changer for the healthcare industry. But naturally, we received a number of questions about the coronavirus. Let's take 1 or 2 of these. First, we're seeing delays or snags in the rollout of the vaccine. A listener would like to know what effect that could have on the markets. And Jim, I can actually answer this one. We always remind our clients that on average, about 3 times a year, The stock market has a 5% setback, and once per year, it has a 10% setback. So if we continue to have meaningful delays in the rollout of the vaccines, it could prompt one of those setbacks. But I think it's important to realize that typically on a global scale, we produce about 6 billion vaccine doses per year for all of the common illnesses that we already know today, like the flu or measles. And we may need up to 10 billion additional vaccine doses for COVID. So this was never going to be an easy task, but we know so far things haven't gone quite as smoothly as we'd like, and we hope that it gets better. But this is one of those things that could cause one of these short-term market setbacks that happen from time to time. So our second question is actually the opposite of that. On a brighter note, if the vaccines are administered and effective by mid-year, how will that impact the economy and stock market? Jim, what are your thoughts on that?
Well, Aliya, it would be very positive for the economy. You think of these two initial vaccines, and let's suppose we get more approvals and more are anticipated. You've had a lot of pent-up demand in the economy over the last year as so many activities have been delayed or put off. It could really help stimulate a more vigorous, more robust recovery. But that would bring with it, Aliya, likely some trend higher in inflation. We're already seeing that right away. Inflation is not high, but it is perking up a little bit. And we're seeing interest rates edge up. So what you'd have, it's not at all clear. You'd have a tug of war, Aliya, between better economic performance, which bodes well for businesses and corporate profits. But against that, you'd have inflation and interest rate pressures. And that might be a standoff, kind of what I alluded to earlier. After fantastic progress last year when the economy was on the whole weak, this year as the economy gets stronger, paradoxically, you might see the market slow down.
Great. Well, the miraculous developments that we witnessed in the healthcare space during 2020 were certainly one silver lining to the year. Another benefit we witnessed was the positive environmental impact of all of us staying home, thanks to the reduction in carbon emissions. Holly, please share with us the trends that you're witnessing in the renewable energy space and the opportunities going forward.
Yes, Aliya, that's certainly right. We did have an opportunity to sort of peek behind the curtain and see what our environment would look like if we were able to reduce greenhouse gases. And in fact, in April, there was a 17% reduction in greenhouse gases compared to the previous year. And you can see from some of these side-by-side pictures just how meaningful that was. This is a picture of Jakarta, Indonesia. And on the next slide, we have a picture of India. And then if you actually look at the data, this next slide here shows us NASA images, where the blue is very healthy for the environment. The blue that you see in that lower right-hand picture signals that more sun is entering the atmosphere, and that means that we have cleaner air. And this cleaner air in 2020 actually allowed the Himalayan mountains to be viewed from over 120 miles away for the first time in 30 years. So these trends and our understanding of greenhouse gases have certainly been ticking up over the last several decades, and we've seen a response through the number of renewables in play. And in fact, the use of renewables has been increasing at a very steady rate, especially over the past 10 years. And when we look at transportation as yet another example of this increasing trend, in the United Kingdom in 2020, electric vehicle sales increased threefold. Meanwhile, overall car sales were actually at the lowest rate since 1992. So the trends are certainly there, and it's something that we're watching very closely. And we care about these trends for really three key reasons. So we'll look at first the true definition of what we consider renewables. A renewable energy is an energy source that's derived from a replenishable source, meaning that it's not depleted when it's used. So think about solar power, wind, geothermal, biofuels, even hydropower. And a fun fact, Kelly Downing actually uses geothermal energy at her home in southwestern Ohio here. So it's definitely picking up steam, but on a broader scale, the US electric grid relies on carbon emitting fossil fuels for 63% of our generation. So there are really three key pieces as to why this matters to us. First are the environmental consequences and the distress on the environment. Number two are the human health concerns. And then number three are the economic consequences. And we'll really focus today on that third part, those economic consequences. We've built our global economy around how the planet works today, around how our environment works today. It really is driven by, you think about agriculture and manufacturing, you think about fisheries and coastal real estate, and it's going to be a very expensive proposition to make changes to these areas as we see these environmental changes. And so as long-term investors, we're paying really careful attention to this because it's our job to say, how are these changes going to impact businesses? Are they going to have increasing costs, or are they going to be able to use the power of renewables and other changes to reduce their risks, reduce their costs, and increase their profits over time? And a big piece to understanding this profit and the economics of renewables is the idea of the green premium. And the green premium is the difference between the cost of a carbon emitting product and the cost of a non-carbon emitting product. A great example of this that we've seen is in solar panels. So the cost of solar panels has decreased dramatically over the last 10 years, which is a big reason why we've been able to see that increase in their usage. And the overall idea is that you want to be able to innovate in this space so that the costs are analogous to each other, that you're not making a difficult economical decision. So we're focusing today on electricity because electricity is the largest emitter of greenhouse gases. It accounts for 25% of all greenhouse gas emissions just in this one sector. But it's also a really important linchpin to help us uncover answers for agriculture, manufacturing, transportation, these other areas that are impacting businesses very broadly. So when we think about this space, we think both about the suppliers of energy and power, and then the users of that power. Commercial and industrial clients account for 70% of US electricity demand. So it's great to see us all making good decisions as individual consumers, but what we really need is the force of corporate America behind this. So let's first look at those suppliers of power. We'll look at NextEra Energy as an example of a company that we favor at Bartlett that has been a very strong investment. And NextEra is a really interesting hybrid between a traditional regulated utility business. You may know it as Florida Power and Light for those friends of ours down in Florida. And then they have an arm that's focused on consulting. So really doing interesting consulting projects for other utility companies to help them build out their own renewable sources. And NextEra has had a leg up in this space because they were an early entrant, especially in wind and solar. And they also are in Florida, where solar energy is ubiquitous. But at the same time, they're facing the same problems as other players in this space, most notably related to the storage and transmission of renewable energy. So NextEra is battling this with some really interesting programs. They have two projects underway, one in Oklahoma and one that you see pictured here out in Oregon, where they're combining the power of wind, solar, and batteries to try to answer some of these problems. So it's important that we understand this idea of supply, but just as importantly, we have to really see how companies are utilizing renewable energy as users of power. And when you think about the costs for corporate America, it's a huge portion of their cost is really related to the power that goes into running their businesses, running the manufacturing, running the giant server farms. And in fact, our corporate juggernauts in the technology space are the largest purchasers of renewable energy. So Amazon, Google, Facebook, Apple, you can add on to this Tesla, Microsoft. These juggernauts are really the ones who are driving policy in this direction. And they have stated that their goal is to have 100% renewable energy powering their businesses by the year 2030. You can see from this chart here that Google and Apple are about 40% of the way to this goal, and Facebook is close behind. Amazon has recently announced some really big projects in this space. And it's really important because these are the trendsetters. These are the businesses that the rest of corporate America pays attention to. So regardless of where you stand on these issues, it's important to track because these guys are setting the pace for other companies. These 4 companies alone make up 15% of the market cap of the S&P 500. And when you add on Microsoft and Tesla, 2 other very big players in this space, it accounts for 20% of the market cap of the S&P 500. So these are really the trendsetters that we're watching and we're paying very careful attention to. This impact of renewable energy is going to be a really powerful driver going forward. And we're paying careful attention both to how to play it from the supply side, but also from the usage side, which is an area where we think tends to be a little less focus from investors.
Thanks, Holly. I mean, all of this really makes me want to go out and buy a Tesla like tomorrow. So I'll have to look into that. But in the meantime, we did have a few questions come in. One listener mentions that progressing towards renewable energy seems appealing, but what, if any, are the downsides of this transition? And I can take this one actually because this is something that our ESG or environmental, social, and governance team has been looking at when we're discussing renewable energy. We're not blind to the fact that renewable energy comes with its own set of ESG challenges. For example, sourcing the rare earth metals that are needed for solar panels or for electric vehicle batteries require traditionally dirty mining practices. And digging up the earth tends to release carbon dioxide into the air, which is the opposite of what we're trying to do. So mining also has some questionable or unsafe conditions for workers that we need to consider as well. So we make sure that when we review these types of secondary issues, we want to ensure that companies we evaluate are not solving one problem while creating another one. But Holly, another listener actually is wondering if you have a sense of the new administration's view on renewable energy.
Yes, they've been very vocal on this. Anyone who watched the inauguration yesterday probably took note of President Biden's mentions of clean energy and this clean energy revolution. And in fact, he signed 15 executive orders yesterday, plus 2 more executive actions. And a few of those were in the climate change space. So he's already revoked the permit for the Keystone XL pipeline here in the United States. And he re-signed to say that he wants to re-enter the Paris Climate Accord. He's named John Kerry as the climate change czar. So they are certainly putting a heck of a lot of resources behind this. So some of it can be done just from executive action, and then some of it will require Congress. But overall, when you look at the Biden plan, you can sort of break it down into these 3 key parts. Number 1 is being a global leader. So rejoining the Accord is a big part of that from the administration. Number 2 is looking at the financial investment. He has stated he wants to invest $400 billion toward the use of clean technology. That is a massive amount of investment. And a lot of that can be done without congressional approval because he'll basically be saying to the different pieces of the government, hey, go spend your money in this way. but some of it will need congressional approval. And then the third piece of it is keeping a very close eye on oil and gas. So probably shutting down many of the opportunities to drill on federal lands, and then also requiring companies to disclose a lot more information along the way as well regarding their pollution statistics.
Lots of changes.
Yeah.
Well, Holly talked about the tech companies that are using a lot of energy and what they can do about that. And in 2020, Zoom was no exception. At Bartlett alone, we spent 14,622 hours on Zoom and had 3,747 meetings, all while wearing pajama bottoms. So Jim will discuss the cloud computing technology behind Zoom and a wide array of other industries. So not only did it help us survive 2020, but it will continue to play a major role in how companies do business going forward.
Well, Aliya, we think it's safe to say that technology rescued our economy in 2020, or certainly large parts of it. And we can relate to many examples just from our daily lives, whether it be working remotely, attending school online, accessing our entertainment over the internet, shopping, financial services, and other examples, attending religious services online, connecting with family members. It really was at the forefront of our ability to adapt and to sustain some kind of a lifestyle. And today we're going to drill down and talk about cloud computing, a very exciting component of technology that was really at the forefront of our adaptation over the last year. And cloud computing, the simplest definition is that cloud computing means you are accessing your technology over the internet. I'm certainly old enough to remember a time when accessing technology meant that I was downloading it from a floppy disk or a CD or a big bulky disk drive next to my computer. And to access that technology, I had to either be at my Bartlett office downtown or my office at home. Cloud computing changes all of that. Cloud computing, sometimes called on demand. It means that by virtue of accessing this over the internet, you can use your technology wherever you are, whenever you want to use it, and on whatever device that you choose. So it's very, very flexible. It's on demand. And businesses like this, because of that flexibility, cloud computing cuts down on equipment costs. Businesses can scale up usage without having a lot of redundant equipment. Upgrades of technology can be easier. It can be more flexible. It can promote faster innovation. So businesses have really embraced cloud computing. And all of us today, whether we realize it or not, we're probably experiencing cloud computing on almost a daily basis. And some examples for you. Today, we're conducting this meeting by way of Zoom, a software that Bartlett downloads from the internet. Many of you have Netflix subscriptions, and so you're watching those popular programs like The Crown. And Netflix is providing those programs to you. They're streamed over the internet so that you can watch them on any device that you want, whenever you want to watch them. And a company like Netflix can provide that. It's called software as a service. They can provide that to you because they're using cloud computing platforms provided by suppliers like Microsoft, or cloud computing infrastructure provided by suppliers like Amazon or Google. Cloud computing is growing. It's estimated that over the next 5 years, businesses will increase technology spending by about 2.5% a year. But the portion that they'll spend on cloud computing is estimated to grow at 20% a year. So a remarkable rate of growth and adoption. And today it's estimated that businesses' technology budgets, about a third of those budgets are geared to cloud computing, but 5 years from now, that will be up to half, and it will continue growing from there. So a lot of growth, a lot of new applications. A classic example of this from recent times, and one that I think you can all relate to, is Disney, which introduced Disney Plus. They started rolling this out 3 or 4 years ago. And Disney Plus, as you may know, is a subscription-based service. For a monthly fee, you get access to their content, which you can download over the internet. Now, Disney really accelerated the rollout of Disney Plus in the last year because otherwise they couldn't have gotten their content out to the consumer, given that movie theaters were closed. So in addition to being very popular with consumers, it was a godsend for Disney, and just a great example of a very prominent company embracing cloud computing technologies. At our event last year, we talked about two fascinating areas of technology that are in kind of embryonic stages of growth, artificial intelligence and the Internet of Things. And these are areas where cloud computing is just getting started. For instance, it's estimated that cloud computing has only penetrated 5% of the possibilities in artificial intelligence. So a lot of room for growth there that's going to redound to the benefit of technology companies. Very, very extraordinary growth. Well, the takeaways to all this is that cloud computing just highlights again the significance of the technology sector being at the forefront of innovation. And certainly the pandemic highlighted that in spectacular form. Technology companies like the transition to cloud computing because it means they're selling their services to you by way of subscriptions. For instance, Microsoft with their Windows and whatnot, by way of subscription rather than by way of equipment where sales can be lumpier and somewhat cyclical. So technology companies like it. It's very important for corporate profits. And because the technology sector is the largest segment of the stock market, innovations like this are very, very important for technology and for the stock market overall. And just closing with some importance even beyond the technology sector. Cloud computing is manifesting everywhere: manufacturing, healthcare, financial services. A great example, last year at our meeting, we talked about John Deere, a great industrial company. And all of us are familiar with those iconic John Deere tractors and combines and harvesters, those iconic green machines. What you may not know is that increasingly those come outfitted by John Deere with very sophisticated cloud-based software that helps farmers engage in things like precision farming. So this cloud computing, the technological innovation is manifesting everywhere. Certainly, the major beneficiary would be the technology sector. And on this chart, we highlight some of our favorites all throughout the technology ecosystem. All of these companies in different ways are being impacted by cloud computing, both in terms of the services that they sell and their business practices. Certainly Microsoft and Apple would be classic examples of companies that are at the forefront. But even beyond the technology sector, in other segments of the stock market, we find a company like Amazon, which is classified as a consumer company, given its preeminence in online retailing. But what you may not realize is that a key profit driver for Amazon is their Amazon Web Services business, which is one of the key players in cloud computing infrastructure. And Google in a similar way. Google is a subsidiary of Alphabet, which is classified as a media company, but Google is also a very, very important player in cloud-based infrastructure. So a lot of great companies that are impacted by this, companies that we own and that we think will continue to thrive. We see this technology megatrend recently highlighted by cloud computing as a very enduring one that's going to be very powerful for our economy, very powerful for productivity, and it's going to be very important for investment portfolios for a long time.
Thanks, Jim. I think I might actually still have some of those floppy disks around here. They make really cool coasters, reduce, reuse, recycle. So anyway, the same thoughts we kind of had about the challenges of renewable energy could also apply in this territory of cloud computing. So one listener asked if the transition of many of our important tasks to the cloud could leave us or the government more vulnerable to hackers. And what could happen if we lose the internet?
Well, Aliya, there's no question. There are some vulnerabilities. You do lose some control over your data. Again, if you think of that example, you think back to the so-called old days of floppy disks. As long as you controlled that floppy disk, you weren't really at risk. You had full control. Now you've ceded some of that in as much as these things are internet-based. We think these great companies like Microsoft, Google, Alphabet, Salesforce, with tremendous financial resources, have the ability to invest in security features that should ameliorate some of these concerns. They have tremendous resources and they're very good at it. But what you highlight is also one reason that Bartlett has hosted these seminars around cybersecurity and just educating people around the things they need to do in their daily lives as they're using their technology, the things they need to do to protect themselves. So it is a risk, the fact that you have less control over your data. There's no question about that.
Well, another area of the economy that could possibly benefit from increased usage of technology is education. In what seemed like the blink of an eye, learning left the classroom and went online. So many of us would argue that this transition was hardly smooth, and we think that there's other facets of our education system that are primed for change. We actually discussed this topic at our annual update in 2018, right, Holly?
Yes, we did. If you had joined us in 2018, we were discussing the idea of education. And at that point, we were saying, this is an area where we have yet to really see disruption. We would welcome some disruption in this space. And fast forward to 2020, and COVID gave us about a decade's worth of technological disruption in the period of a few weeks. And as a parent with school-aged children, my heart goes out to all of those parents out there who became educators during 2020, and a debt of gratitude goes out to all of the teachers who helped us get through that tremendous situation. When we think about these changes in technology, it is really driven, and in education, it's really driven by two key features. One is finances, and the second is the technology side of it. So first, we'll look at the finances. Over the past 40 years, the cost of college tuition has gone up by 1,000%. This compares to an increase in healthcare expenses of about 600%, and standard inflation is up about 200% over that time period by way of comparison. Jim spoke about some of these amazing technological changes we've seen and the amazing miracles we've seen in healthcare. It's hard to say that the educational experience has really delivered that amount of tremendous value above and beyond over that same period of time. So the increase in this tuition, part of it is due to a decrease in public funding. From 2008 to 2013, the cost of tuition went up by 27%, while public funding actually dropped by 22%. So this is a tremendous change that's putting a lot of pressure on individuals, on the students, and on their families. Student loan debt now stands at $1.7 trillion. This dwarfs the amount in credit cards or in auto loans. And it's important to think about the burden on the individuals. So on each student, the average student loan debt is about $30,000. And the interest rate on this debt is about 6%. So that includes lower interest rates on federal loans and then higher rates on some of the private loans. But when you put this package together, it's certainly a burden on families. And really, universities are having to pay very careful attention to this and really do something about it. So what we thought was a manageable situation pretty much turned into an emergency overnight for universities. But not all higher ed is created equally. So when we think about private schools, they're impacted much more because their funding streams tend to be primarily driven by tuition versus public universities that tend to have more diverse funding mechanisms. The makeup of the student body also matters. Pre-COVID, about 12% of our US student base was made up of international students. However, this 12% base accounted for 28% of the total share of tuition. And making this up is no easy feat now that we don't have nearly the same number of international students here studying in the States. It takes about 4 in-state students to make up for the loss of 1 international student to come up with that funding differential. So universities are reacting, and you can see just a few of the headlines here as to changes that are already underway. Colleges are shedding assets, they are coming together or even closing down some small institutions. They're cutting back on majors that are less popular, and they're actually even adding surcharges for the more popular majors. So the financial situation is one of the biggest pressures in this space. But then we also have the technological changes. The higher education as an industry is a $700 billion industry. So you put numbers like that out there, and the big tech guys, most notably Apple and Google, start salivating, and they say, hey, that's a huge industry that can actually move the needle for us. I want a piece of this. Outside of the big tech, you also have venture capital coming in, and we've seen a tremendous amount of new money coming into venture capital in 2020 that's seeking opportunities in educational technology. And when this technology is used really well, it can work. It can democratize education, and it can allow universities to have scale that just wasn't possible before. So you're no longer really hindered by the size of your classroom. You can open it up online. One great example of this is out of Yale. In 2018, the most popular course at Yale, which was called Psychology and the Good Life, had 1,200 students enroll in it, and that made it the most popular course in the 300-year history of Yale. Yale opened this course up for free online, and over 1 million students enrolled. That is dramatic. That is so amazing to see that you can really offer this to so many more people. So looking a little bit deeper at the technology space, another aspect of this is the 5G. And last year, my colleague Brian Antonucci walked us through a really interesting discussion of how 5G was going to play out and be useful in our personal lives and some of the technological ways we were playing it. And we're continuing to really pay attention to this space. And 3 of the big players in the space that we're watching are Comcast, Verizon, and American Tower. So Comcast and Verizon are really big when we think about the wireless or the Wi-Fi networks that we're working on. And then American Tower is actually out there building those 5G towers. You need a lot more 5G towers to transmit those signals than you do with 3G or 4G service. So getting 5G out there to all of our communities is going to be a game changer for the educational experience. And this is just one piece of the pie. But overall, when we think about education, it's a space that has really been ripe for disruption because of the financial characteristics pushing it. And then also the technological changes coming in play too. So this is a space that, as we think about it, especially as we do financial planning for our clients, and we're planning to say how much to set aside for children or grandchildren for education, we're keeping a really close eye on it. And it also impacts many of the companies we invest in as well.
Thank you, Holly. It sounds like college could look a lot different in the coming years. We actually had a questioner ask us, given what you're saying about higher education and it's leaving more and more people behind, do you see the value of a college degree becoming somewhat overrated, or are there other options instead of going to a 4-year college?
Yes, every family is going to have to do their own math on whether the credentials, the name brand of a university, the overall experience is worth it. We've actually seen some of those big tech companies come into the space as the educator themselves. So Google just announced back in the fall of 2020 that they are going to be offering certificate programs that they'll see as an equivalent to a 4-year degree. So that may not be a path for everyone, but it may be a path for those who do not have access to a traditional 4-year opportunity.
Great. Well, that is the end of our presentation for now, and we'd like to take some of your questions that have come in. So what I have been seeing mentioned a few times, Jim, is how do all of these trends kind of affect our asset allocation thoughts for clients? How does it affect what we're thinking about investing going forward?
Well, Aliya, it certainly impacts the sectors that we prefer within the equity or stock component of our portfolios. And in recent times, the largest two sectors have been technology and healthcare. And there was a time 20 or 30 years ago, it would have seemed unusual for Bartlett to be heavily invested in technology. It was kind of a boom bust sector at that time with short product cycles and whatnot, a lot of volatility. But by virtue of things like cloud computing that I described, so many technology companies have become much more consistent in terms of their financial performance because they're selling their services by way of subscriptions that tend to recur pretty consistently. So I just say that within the equity segment of a portfolio, the fact that technology and healthcare are among the preeminent sectors is one manifestation of how the importance of this is showing up in portfolios.
Kind of along with that, what are we seeing in the classic growth versus value argument?
Well, what Aliya is referring to for our listeners is the fact that for the better part of the last decade, so-called growth companies, which are often found in technology, healthcare, consumer products, companies that can grow at above average rates, has significantly outperformed what used to be called value stocks or value companies that tend to be found in sectors like energy or industrials or financial services. I think, Aliya, the important aspect of our approach is we've gotten away from a real hard and fast distinction between growth and value. Warren Buffett said years ago that a successful investment has to have characteristics of both. You can't appropriately value a company without factoring in growth potential into your formulas. So I would say it just requires a much more adaptive way of thinking about companies and thinking about their growth potential over a long period of time, and how enduring that growth potential is, and how big are the markets that they serve.
Thanks, Jim. We also had a couple other questions about education. So one questioner asks, will a move towards free college, which I'll preface that we don't know if that's a great idea, but could that kind of reduce the cost of tuition for the rest of the colleges, Holly?
Yeah, we're not big fans in general of this idea of free college. It's one way to go about it, but it also, there's so many other issues in our educational system, as we all know, that hinder students before getting to school. It's not just the cost of it. So we really need to make sure that there's plenty of investment paid to our public school education in the K through 12 space and even early childhood, not just in the college space. So a more interesting way of looking at it would be figuring out ways of reducing the interest rate, not just loan forgiveness, but just making it a little more affordable for people. And then making sure that from here on out, that tuition doesn't continue to increase at such a dramatic pace. that you have more realistic tuition expectations that families can afford going forward.
That definitely makes sense. And I think we have time for one more question. With all of the COVID and the relief that the government sent out, what are our thoughts on how taxes will be affected going forward, or what that will look like, paying back all of the resources that we were receiving? Holly, what are your thoughts on that?
Yes, we've been paying careful attention to Biden's tax plan and what he has stated he wants to do, which is up for debate at this point as to how much we'll actually be able to accomplish. So certainly if every single Democrat voted yes for a Biden tax plan, and Kamala Harris is the deciding vote, that you can pass some things through. But there's a lot of people in the middle there that some of the more extreme decisions might not make it through. So it's very likely that we will see an increase in corporate tax rates, probably not back up to the level that they were sort of pre-2017, but we could see an increase in corporate tax rates up to about 28%, and also perhaps an increase that's certainly up for debate right now too.
Great. Well, that is all that we have time for today. We thank you so much for joining us. You will receive an email following this, the webinar, that contains a link to a survey to provide feedback on today's events. So we want to make sure that Bartlett continues making these webinars worthwhile for you. So we'll also be sharing a recording of the event in the coming week. If you know anyone that might be interested in watching it, and you can forward that on to them if they weren't able to make it. And then to stay tuned for future events, please follow us on social media or sign up for our e-newsletter at bartlett1898.com. Thank you so much.
Thank you.